Hello again. Um, the topic of this video is, in principle, hybrid mismatches. But before we begin to speak about that, allow me two remaining remarks on license barrier questions. First, is this topic treated in the Anti-Tax Avoidance Directive of the EU too? Um, You remember that the concept of this lecture is to show you measures against tax saving models, which are easy and frequent. And so I showed you that license fee payments can serve very easily to shift profits to other countries by operations which can easily be arranged on paper. And so the question naturally arises if the ATAD of the EU also covers that topic. And the answer is a clear no. The probable reason for that, I'm not familiar with the internal information or so, but I could understand or I could expect that several states in the EU have preferential tax regimes for license fees, and so they want to attract revenue from other states in form of license fee tax saving models. So they want to profit from these models, and for this reason it will be highly difficult to obtain a 100% acceptance in the Council of Ministers for any measure directed against tax saving models working by license fees. For this, there would be necessary first general consensus that license fee tax saving models are bad. Now, the countries which run such models usually bring forward that um, granting attractive tax conditions for research and development is a good incentive to further research and development in their countries. And so that is their argument, or perhaps only their pretext for holding up such models. And yeah, to come back to the point where we started from, that explains why more fiscal ministries are reluctant to give their consent to a rule against license fee payments. Well, at least all countries have agreed to, in the ATAD, to introduce a general anti-abuse rule. So that might enable the paying entity to withhold favorable consequences in cases where a license fee payment arrangement is regarded as not genuine and mostly triggered by tax purposes or motives. If that could hold in court, one doesn't know. So the multilateral instrument is even something which is on a higher level or on a wider level than the ATAD. It does not cover any rule restricting the usage of license fees too, because probably there are the same member states. And another reason is, as in the case of interest payments, the double taxation treaties usually do not regulate the way how the tax base is computed. They only say who can tax which part of the income of the taxpayer, and so it would probably not fit into the general framework of a treaty on double taxation treaty changes to include rules on the determination of the tax base. But also by the MLI, general clauses are introduced into most double taxation treaties by which it is possible to withhold the advantages or the privileges of a double taxation treaty to operations where the principal motive or one of the principal motive is only the wish to save taxes. So at least a certain amount of legal uncertainty has been created in cross-border cases when it comes to license fee models. Good. That having been said, we can now concentrate on hybrid mismatch transactions. That is something which the average person does not really understand or know. It's rather recent development. Okay, that's overdoing it a bit. It has been known for some decades, but it has really become a very important topic of discussion during recent years because more and more operations in the market try to make use of transactions like these. So it is justified to have a closer look into these transactions, especially after now the Antitax avoidance directive has taken these operations under attack by demanding specific countermeasures from the member states. So that explains why this chapter can't be left out. We are here now after the discussion of transfer pricing questions. That's in paragraph 1 ASDG. We have then talked about the interest barrier and license barrier, things which have no longer been introduced in the ASDG but have already been included in the regular income tax by the legislature. And now there is a topic which is still to come in the future into German legislation. At least general rules are still missing. At the moment, I'm speaking in the year of 2021. And hybrid mismatches so are the topic of this next chapter. And let's have a look what we can find out about them. So we first have to think about what hybrid mismatches are. Then we have to distinguish between hybrid mismatch transactions, what that is, what we can do against that if we are the state, and then also a small explanation or a very small bit of information on what hybrid mismatch entities are, and that shall be enough on that topic. So hybrid mismatches, ladies and gentlemen, that is more or less a situation where something, transaction or an entity, a situation is seen in a different way by two states so that a contradictory outcome is the result. That's, by the way, why it's called a mismatch. It does not match. The views of the two countries does not match, do not fit together. So hybrid mismatch usually occurs because something or someone has characteristics of different things mixed. So that is why it's called a hybrid. And that leads then to a contradictory assessment of the situation in both or even more states involved. That's the mismatch. And hybrid mismatches can occur with, as I already said, transactions or persons. Now, if the contradictory outcome is in favor of the taxpayer, then hybrid mismatches are excellent tools for tax saving. And that is why in today's world, the states try to coordinate countermeasures against the consequences of or against the use of hybrid mismatches in tax planning. Well, naturally, it could happen that a hybrid mismatch is qualified in a way that you get the negative consequences in two states or so, that every state views the situation under an aspect which is negative for you, and so that the negative consequences even accumulate. Naturally, that is something which people avoid on their own already, in their own interest. So that is not the problem for the states, but these positive, effects, accumulation of positive effects due to a hybrid mismatch. That is what is dangerous under the aspect of tax planning for tax revenue of the states, and that is why hybrid mismatches in that way are in the moment of the focus, in the focus of public attention. Now, that was all still abstract, so let's think about some example. Imagine a payment is made from state A to somebody in state B, and now state A says it's an interest payment, so for them it's a business expense. But state B regards it as a dividend which somebody gets for giving equity. So let us again view the consequences. If state A sees the payment as interest payment for a credit, that means they will allow a business expense. As we had that with all that interest expense planning things. But now the trick is in the hands of the recipient. It will be qualified as a dividend because under the legal criteria of the target state, the payment will be qualified as a dividend and the underlying amount not as a credit but equity. And now imagine Germany or other states often have exemptions or reduced tax rates for dividend. So imagine the person who gave money, who gave what is characterized by the other state, by state A, as a credit. If state B sees that as an equity investment and will regard that interest as a dividend payment, then it would be tax-free. So that would mean state A deducts it as a business expense. The money leaves that state untaxed, let's say 2 million. And state B then says, well, we won't tax it. It's a dividend. It will have been taxed in the other state. And so you could shift money from the one state to the other, and this profit would never be taxed in no state at all. And so such a constellation is an excellent opportunity for avoiding taxes legally. You don't lie. Every state, if you gets the full truth, every state knows what happens, but they all say the mistake is not done by me, it's done by the other state, by their wrong legal rules. So people will do their very, very best to find systematically such situations where you have such a hybrid mismatch constellation and then use it. The two most important categories which one can describe of such hybrid transactions which are positive for the taxpayer are named after the tax effect. The one is DNI constellations, the deduction on the one side, but no inclusion on the other side. For example, the example which I just gave you. And the other thing is DD constellation, so double deduction. One and the same amount can be deducted from different profits in different states because the states involved have different opinions on to which profit that expense shall be or should be assigned. Examples for DNI. Imagine we have an interest payment of 10%. Now that contains a hidden profit distribution of 6% because adequate interest rate is only 4%. Now imagine that in the state of the taxpayer, the full 10% are accepted as interest, so they lower the profit. In the state of the recipient, one looks on the matter very thoroughly and finds out only 4% are really interest, 6% is a hidden profit distribution, so the 6% are a dividend, and the dividend would normally be tax-free under 8B1. So that would be a DNI constellation. The 6% leave country A free of any tax burden because they are treated there as a business expense. They lower the profit. and the money is no longer included in the taxable profit in the other state. So 6%, let's say 6 million or so, can be earned by the group without ever being taxed in one of the two states. Fantastic. And naturally, if you get along with that once, the news will spread and all others will copy your approach, and so you have a kind of a black hole for the state's tax revenue. All people will try to do this. For a DD constellation, well, there are many potential situations too. Imagine we have an asset which is leased out from state A to someone in state B in a cross-border leasing transaction. Now imagine the tax law of state B, so where the asset is used, qualify the leasing contract as a hidden purchase contract. And so the customer is, although he or she doesn't have the legal title of owner, is regarded as economic owner. You remember that concept in Germany. We know that the economic owner is a person who, under the usual circumstances, can exclude the legal owner from any influence on the good in question for the whole remaining useful life of that asset. So, state B, their customer B would be entitled to claim depreciations because customer B is regarded as the economic owner. State B thinks that asset belongs to B. Now, under the legislation of state A, it might be that state A does not know such a thing as economic ownership and does only follow the legal juridical ownership concept. Or even if they know such a thing like economic ownership, their criteria to decide upon if there is economic ownership of somebody else or not, their criteria might be different, so that state A still sees the juridical owner, Mr. or Mrs. A, as the owner of the asset for purposes of tax law. So state A would say, asset is owned by A can claim depreciations. That would be a double deduction constellation, although the effect is only a temporary one. If you do that with an asset which has a value of hundreds of millions or so, the fact that you can depreciate it in two states probably has a finance advantage, a liquidity advantage can happen. What else might occur? You might have a partnership ABC and it runs a firm in Germany. Now, you know in Germany a partnership is a transparent entity. And you know also that in Germany there is something called Sonderbetriebsvermögen, which has to be shown in a Sonderbilanz. So Sonderbilanz property, that's a concept which we know. Imagine partner C has taken up a credit and pays interest on it to a bank. Under the perspective of Germany, the credit is Sonderbilanz property of partner C, so it is regarded as a part of the business property of the partnership, although it is only owed by one of the partners alone. So the interest which C pays to the bank can be, from German perspective, deducted from the profit of the partnership, of that business here in Germany, during the uniform and separate assessment of the partnership profit. Now imagine what is relatively realistic, that the law of state C, the partner's state of residence, do not know such a thing like Sonderbilanz property. For them, the property of a partnership is only the property which all the partners own, and the liabilities of a partnership are only those of the partnership itself. For them, it's clear if a partner takes up credit for business reasons, this is property of the liability of the partner, and as it does not belong to the partnership, which has a permanent establishment abroad, for them this belongs to the state of residence of the partner. Worldwide income means everything counts apart from the things which under a double taxation treaty have been given to another state exclusively, and from their perspective, the liability which C alone has taken up has nothing to do with the partnership, so they accept the credit still as something which affects their tax jurisdiction, and they also accept the interest as deductible business expense. So one and the same interest payment can be legally deducted once during the business profit calculation in Germany, and second, during the computation of the rest of the worldwide income of partner C. So if the partnership profit in Germany is tax exempt in the state of residence of C, that's really a good bargain. You pay 1 million and you can deduct 2 million in different states in total from the tax base. That's nearly financing itself. What else might happen? You might have a group of enterprises which consists of a company A and company B, parent and subsidiary, and the group shall be taxed under German tax law as an entity, so as a so-called Organschaft group. Now, the parent company might have the place of management in Germany and the seat outside Germany, so it's unlimited tax liable in 2 states. And imagine in the state of the registration where they have their statutory seat that is abroad, the existence of the group does not matter for taxation, so that the profits of the German subsidiaries do not matter for the tax treatment at home. And now it might be that the loss of the parent can be offset against the profits of the subsidiary in Germany. Whereas if the state where the parent has been registered, if that ignores the subsidiaries and only taxes the parent as such, then it might be that the loss from Germany can be offset under their rules against profits of that parent company from elsewhere, or against profits of subsidiaries in their state. One does not know. So even there, it could be possible that one and the same expense or loss could lower 2 different profits in 2 different states according to the different criteria of states where the money belongs to. More and more of these constellations have been systematically found by tax planners during the last decades. It sounds like paradox. In theory, the countermeasure which a state should take is simple: ensure that an amount can never be deducted twice, or against the DNI model, that nothing can be deducted which is not included on the other side in the income. So, but the question is then, everybody agrees on that, but which state has to draw consequences? For that, you have to decide which perspective is wrong if they conflict, which is utter. And the 2 possibilities is, or are, you could either say the state where the money goes to includes it into the taxable income, or you could say the deduction is denied in the state where the money comes from if the recipient does not have to tax it. These 2 alternative solutions exist, and the problem is, if you don't want to create a new chaos, you have to agree or to create agreement between the states which of the 2 approaches will be followed worldwide. Because if both happens again, you have again a contradiction, now to the disadvantage of the taxpayer. So in the EU, that was a good reason why the EU said we need now rules on hybrid mismatch transactions in the anti-tax avoidance directive, because that justifies EU legislation. One member state alone, or each member state alone, cannot afford, cannot, no, cannot reach a good convincing solution without a central coordination. We need an obligation to follow the same principles. So here, indeed, it's justified to issue a directive on that, because otherwise you have chaos. And so the EU said, okay, there is a primary solution that shall be that the state of the payer shall deny the deduction as a business expense. And only if that does not happen, then the state of the recipient shall include the amount received in the taxable income. Let's apply that principle, for example, to the hidden profit distribution case. If I pay 10%, but justified are only 4%, then naturally, if everything goes correctly, the state where you claim that inflated 10% as interest expense should say, no, only 4% are deductible, the rest is not deductible. That's correct and convincing. But if that is overseen there, overlooked, does not take place, then we should say the state where the money goes to should then include the payment into the taxable income. So a two-step approach. First, deduction should be banned. But if that goes wrong, for example, because it comes from a non-EU state which does not follow the ATAD rules, or if the money comes from France or so and the French tax inspector or tax officials have decided wrongly and can't be corrected anymore, then the negative conclusion should be drawn in the inland. We already have exactly that basic approach in form of the corresponding treatment principle for hidden profit distributions. These rules, remember that, say if a hidden profit distribution is not treated as a business expense in the state of the payer but for taxed, then the tax exemption under 8b for the dividend remains valid. But if the state where the money comes from allowed the hidden profit distribution to lower the income and so to leave that jurisdiction untaxed deduction, then the German law says, okay, a dividend will be not tax exempt if the money has, by the company where it comes from, not be taxed, not been included in the tax base. So indeed, that is already what happens partly in German law. DD constellations, again, two solutions are possible. You can there distinguish the country where the money was invested, so where the profit was generated, or the country where the taxpayer resided, country of residence. Typically, such DD constellations happen in cases, especially the second example which I gave you, that one state deducts things because it thinks that is connected with an investment in my country, and the other state says, no, this is just a part of the worldwide income and has no firm connection with something which happens abroad. You can here say we eliminate the deduction where the payment comes from, so in that state where the money has been invested. The ATAD calls that the payer jurisdiction, the paying entity, for example, the partnership, or the deduction shall be denied in the state where the investor resides. They call it investor jurisdiction. And again, you must make sure that not both states act so that, because if you do both, then you replace a DD constellation by an ND-ND, so no deduction constellation, and that would be unfair too. So you must coordinate the reaction of the states to such a tax-saving model too, and again, that justifies the ATAD approach. The ATAD approach is laid down in Articles 9 to 9b, and the ATAD says, okay, in DD constellations, the primary solution is that the state where the payment does not have its source, so where the taxpayer only lives, shall deny the deduction. The idea is if the money really was, let's say, invested in Germany or relates to an investment in Germany, then economically it belongs to an investment in Germany and should be taken into account when the profit there is calculated. And only where that has not happened. So if the state of residence of the taxpayer has given the deduction, then the state where the money has been used shall deny the deduction as a kind of secondary approach. So the interesting thing is both measures are in principle possible. The idea is, as we cannot always make sure that states act according to the principles correctly, we just establish, let's say, an order in which the two states have to act. First, it shall be ensured, or the first and most desirable solution is that the state where the money has been invested accepts it as a business expense, and that the country where the taxpayer only resides denies. But if that has gone wrong, so if in the state of residence of the taxpayer deduction has been granted in violation of principle number 1, then the state of source where the money has been used shall react and deny the deduction. In practice, that brings along the need to exchange information on the tax treatment in concrete cases, in cross-border cases. The present rule for cross-border business expenses of a partnership or a partner follows that principle already, because the German rules say Sonderbilanz business expense of a partner is still deductible in Germany. We see it has an economic connection to business done in Germany, but we only accept the deduction under the condition that that partner could not offset and cannot offset the amount in question from the profit which is taxable in another state, so usually in the state of residence. That means primarily we accept the money, but we ask if there has been a deduction in another state, which from our perspective would be wrong, but if that has been obtained, then we cancel our deduction. With DD constellations, it's also possible that a DD constellation results from the fact that a taxpayer has two residence states. For example, seat in state A and place of management in state B. Now imagine that a company has a profit of 100 each in state A and B, and it has a loss of C in state C of minus 100,000. Let us further assume state A and state B have a double taxation treaty, which says that the profits of the permanent establishment in A are tax-free in B, and that and the other way around. But state C has no DTT with either of the two states, so the worldwide income, as far as it comes from state C, is still relevant. Might be. In that case, the worldwide income in state A would be 100,000 from A minus 100,000 from C would be 0. In state B, it would be 100,000 from state B minus 100,000 from state C is 0. So the same loss could be deducted in two different states, two different profits. That's contradictory. By the way, in all cases where you have an Article 21 OECD model convention, such a constellation is usually not possible, because when you have a DTT between state A and state B, which follows the OECD model, then Article 21 says the rest of the worldwide income only goes, so the income from state B only can be part of the tax base of the primary state of residence. But it might happen in more complex situations, for example, in cases of group taxation or so, that Article 21 does not make the situation so clear, and then you might get successfully away with that approach. So the simple example here does not work in practice due to Article 21, but more complex situations, there you might end up with exactly that basic approach. For this reason, there is an Article 9b which says, okay, if there are two resident states of the taxpayer, then rules are established which state of residence shall deny the deduction. In German KSTG, you have a similar provision already established for the case of a group taxation, which says negative amounts of a group member can only be taken into account if they cannot be set off in any other foreign state. What's now hybrid entities, ladies and gentlemen? Well, it's a legal entity where the idea what it is not clear for both states. So it can be unclear if something is a partnership or a juridical person. So if it's transparent or non-transparent. And a mismatch would be if the one state says it's transparent, it's a partnership, and the other state says no, it's a company. The other possible confusion might be the entity has no clear state of residence, so most frequently two of them. Now what can happen then? Imagine taxpayer A makes a credit contract with entity B. Now entity B is regarded as a corporation by the state B in which it runs its business. So for this reason, there in state B, the credit contract is accepted. The interest paid from B to A is a business expense, which lowers the profit of entity B, because if a GmbH, and B thinks this is a kind of GmbH, pays interest to a shareholder, that is accepted and a business expense. Now, in the state of taxpayer A, the B entity is regarded as a partnership, or if it's held as with 100%, then it's even a sole proprietorship. And now, at least in that constellation, you can say a contract between a sole tradership and its proprietor is not possible, because the sole tradership, the owner, that's the proprietor, so A. And the person who gives the money is A. So now A can't conclude a contract with A himself. So no contract existing from the perspective of country A. No interest payment possible. So no interest revenue possible for A in state A. So that means there is no money which is taxable from the perspective of state A. What state A see from their perspective is taxpayer A has withdrawn some money from his or her own sole tradership in country B. That money had to be taxed under the DTT rules in state B. That has been done also, and so it's not their business to tax that money from their perspective. So no income at all. And in the end, again, you have that effect. The amount is neither taxed in state A nor in state B, just due to the hybrid character of the paying entity. Another well-known example where that plays a role is the famous construction which is called the double Irish with Dutch sandwich construction, a famous tax saving model which has been set up in the 1990s using Irish companies. Basically, what happens is in Ireland there is a subsidiary company which earns a mass of money by delivering goods and services to the whole European market. Now, Ireland has a relatively low tax rate. Under Article 7, the only state which can tax the profit of an Irish company is Ireland, because that Irish company has no PE nowhere else. Now, the trick is that the Irish company doesn't keep the money. It pays a license fee for, let's say, a brand or a business concept to a Dutch parent company. Here you see again, license fees are an attractive means of shifting money to other states. Now that Dutch parent company owns the Irish company with 100%, the license payment goes from Ireland to the Netherlands without Irish withholding taxes, because this is a license payment which qualifies for no withholding tax treatment under the interest and royalty directive of the EU. So the money arrives in the Netherlands untaxed. Now the Dutch parent company has in turn to pay another license fee to its own parent, and this is again a 100% parent in Ireland, so an Irish company again. So the license fee is mostly kicked back to Ireland. That has some very positive effects for the Irish grandparent company, because under Irish law in former times that has been changed due to some rumors, but in former times that would have not been taxable revenue for the Irish company. Now, that constellation also had some positive effects under the US perspective, because these companies were part of a US group. From the US perspective, at least the two lower companies were seen as sole traderships, as transparent, with the consequence that the two license payments did never exist, and that the three enterprises just were one. From their perspective, just an Irish grandparent company with two PEs, one in Ireland, one in the Netherlands, so that the license payments did never occur from the US perspective. So what the US perspective sees is that an Irish company earns money in Ireland, and then Ireland, under its own rules, just taxes not the whole profit with 12.5%, but only a very small percentage, and leaves the rest untaxed. That is a clever usage of hybrid entities, because license payments and interest payments and similar things would have incurred or caused consequences under the so-called US CFC, or controlled foreign companies taxation. But if the foreign companies at the lower level do not even exist, that risk does not exist. By the way, if you don't understand that at the moment, it's far too complicated. Just grasp a general idea that it might have been detrimental from the US perspective if license fees had been kicked around, and now under the US perspective, as it is hybrid entities, these license payments did never exist, so they could do no harm. So relatively clever. So a hybrid entity is usually an entity which is regarded by the state of activity as a corporation, and in the shareholder state as a partnership as before we described that. The reverse constellation might also be possible, so that an entity is regarded in state A as a partnership where it earns the money, and that state B, where the owners reside, regards the entity as a corporation. That's especially tricky if you look at the partners or at the partnership. Imagine a partnership has income from, let's say, Germany. Now, Germany says the income from business is taxable if the owner has a permanent establishment in Germany. Now imagine that partnership doesn't have a permanent establishment. Then we would say, okay, then what they earned can at least not be covered by the rule that the owners owned money from the partnership from a German permanent establishment. So we would say we have no right to tax it, and we would leave it untaxed. We would see the owners are partners ABC in their home states, and under Article 7, as they don't have a PE here, they can only be taxable with the money at home. Now, if the state where ABC lives says the partnership is not a partnership, it's a corporation, then from their perspective, in the country where the corporation resides, Germany for example, only Germany would have the right to tax that corporation and that corporation's profit. So for them, it doesn't play a role that the corporation doesn't have a PE. For them, Article 7 would refer to the corporation, would give the taxation right to Germany, and it would not be their business that Germany did not levy a tax. So in the end, due to the confusion, no state levies a tax. This is called a reverse hybrid entity. It's just the same, but hybrid entity would seem, and reverse hybrid entity just makes it possible to keep the two possible variants apart. Now, ladies and gentlemen, one thing is clear. You would be a genius if you could be able to memorize and understand these things immediately. The only thing which you can probably keep in mind directly and immediately on hybrid mismatch entities and hybrid transactions is the whole tax planning lives from confusion, and so if you get the idea, I'm confused, you have already grasped the most important detail. Then it's recommendable to know what a hybrid mismatch entity is. Most relevant case, the one sees a partnership, the other sees a corporation, and what a hybrid transaction is. Germany has a mass of rules where certain very specific things have already been covered. 50D ESTG contains at its end some sections addressing that. 9A ATAD addresses things. The OECD Model Convention, the exemption article has a fourth paragraph which then says, okay, certain exemptions are not granted if there is a qualification conflict. And the multilateral instrument also deals with hybrid mismatch entities and their rights under a double taxation treaty. They address it in Article 3 and Article 5. So there are worldwide many measures underway to fight tax saving constructions by these constructions. Where somebody has double residence, for example, the double taxation treaties try to improve the way how they deal with that. And one could also use that, so a hybrid mismatch entity where the place of residence is not clear. How could one use that for tax planning? Yeah, one could say one of the two states allows a deduction, doesn't allow a deduction in case of losses, but you could also play around with different constellations, which makes it clear why you want to establish also a solution on the double taxation treaty level. Imagine state A has a high tax. It has not concluded any DTT with the state of tax oasis. That's a state with a nearly non-existing tax. But state A has a DTT with state B. And now the trick company is established in state B and has its statutory seat there, but only the statutory seat. But that is sufficient usually. The double taxation treaty between state A and state B is now applicable because trick company is under the DTT A and B resident under 4.1 in state B. Now that means that the license fee which is paid from state A to trick company can, under the double taxation treaty, only be taxed in state B, which means it can under no circumstances be taxed anymore in state A. Good. Now let's look further. Now if state B and the state of tax oasis have a double taxation treaty, and the trick company has its place of management there in tax oasis, then for the DTT between state B and tax oasis, trick company is resident in tax oasis. That means state B has, under Article 21 of that double taxation treaty, renounced on any right to tax the license fees coming from state A. And that's the trick. You use that double residence here to gain first the right that state A leaves the license fee or lets the license fee go without any tax. And then that state B, where the license fee seems to go to from the perspective of state A, that state B doesn't touch the license fee because of its own agreement with the state of tax oasis. In the final effect, so the license fees go from state A to state tax oasis as if these two states had a double taxation treaty. And this is in all probability a very unwanted effect, because if tax oasis is a tax oasis, they perhaps only take 0.5% or so. And so we would not give them the right to get a license free from our territory without any tax. But here, by that clever stepping stone model based on double residence, that can be achieved, and naturally the states want to counterattack that. So they want to say double residence. If that happens, we should be able to find convincing solutions for that. So to refrain from the tax exemption for license fees in the source state or such things. So Article 4 MLI also deals with that, or with similar effects. By the way, I think it would not cover the situation which I just described above, so it would not even be sufficient for that. So you see, things can be complicated. Good. Now I think I rather talked your ears off. You will need a break. Hybrid things are confusing. That's the main message. But there are rules which solve the problem if you manage to coordinate the reaction of the states involved in a way which works. Good. Now, as you see here, the next chapter will be on personal tax liability and tax saving opportunities. So if it can be a measure to save taxes if you change from unlimited to limited tax liability, or change your status backwards from limited to unlimited, and so on. This is a new topic, and this is naturally and a good topic for the next video. Thank you very much for watching this one. Don't stay confused too much. If you got a kind of a hybrid impression of that video, that's okay. You have even seen that I often mistook some words or stammered around, so confusion really fits. Yeah. And then nothing remains for me than to say thanks for watching, and I hope you come back, although hybrid things are bad. Okay, till next time.